This is your fifth program in the series on the principles of accounting. On January 1, Robert Johnson organized and invested $10,000 in the Bob Johnson TV Repair Company. On that day, he bought a $5,000 van, paying $1,000 down and borrowing $4,000 to pay for the rest of it. He bought $2,000 worth of electronic parts for inventory, paying $1,000 in cash and charging $1,000 worth. At the end of the day, Johnson made up a balance sheet which the bank and the credit bureau asked for. How much was his company's net worth? That is, how much equity did he have? Yes, of course, but he didn't have that much cash left. He started with $10,000 cash, but paid $1,000 of it on the van and $1,000 on parts for inventory. Thus, he had only $8,000 left in cash. The other $2,000 was invested in part of the van and part of the inventory, which, like cash, are assets. How much did the company have as total assets? Right. Total assets were $15,000, and the equity or net worth was still $10,000. How much in liabilities were there? Yes. We might say that the Johnson Company has assets of $15,000 for which it owes or has liabilities of $5,000, and thus there is an equity of $10,000. Now, assume that a total of $500 is paid for utility deposit, advance rent, and insurance premiums. We'll call this deposits and prepaid expenses, or just prepaid expenses. If the Bob Johnson TV Repair Company operated on a cash basis, advance payment of rent, insurance, and the like would merely be charged as an expense when paid, rather than recorded as an asset until the expenses are accrued, as is done in the other kind of accounting system. What kind of system is this? Right. In paying for these prepaid expenses, the company reduced one asset and increased another asset. What were they? Yes. At the end of January, Bob Johnson found he had received revenues of $4,000, made purchases of $1,000 of parts for inventory, and accrued a total of $2,000 of salaries and other expenses. What other information is needed to find the profit? Right. In this case, we will say that the inventory of parts remained the same at $2,000. What was the profit? Yes. The January net revenues for Johnson's company would be easy to determine. Just the total of sales slips less total credit slips for returns. These transactions would be entered on a pair of columns in a combined journal or in a special sales journal. The expenses, however, were of several kinds and required a number of month-end adjustments to determine. Rent, utilities, and insurance expenses totaled $400 for January. But on January 1, there were deposits or advance payments of $500 for these expenses, so by January 31st, we will say that no further cash payments for them had been made. In making month-end adjustments, what would be left in these accounts? Yes. Bob Johnson had two assistants in the store and shop who were paid $1,000 total wages in January. How is this shown in the journal? Right.
The automobile expenses were $200, the depreciation on the automobile $100, interest expense $100, and miscellaneous expenses $200. Total expenses were then $2,000. Do you have enough information now to calculate how much cash was left? Right. Here are the list of accounts and their balances before adjustments. What's missing at the top? Yes. Revenues, less the cost of the goods which were sold and the expenses, will give the profit on an income statement. In this example, there was no previous month to compare revenues and expenses, so Bob Johnson does not know if they are increasing or decreasing. Which trial balance accounts would you carry over to the balance sheet? Right, and like the income statement, it should have the company name and the title of the report. The income statement refers to the accounting period, while the balance sheet gives the effective date. Both reports must add the earnings or losses in order to make their respective accounts balance. If Johnson required $1,000 for his personal needs, he withdrew this amount from the company in cash. Since he owns the company and supplied all the equity capital, he has this right. But if the company does not make a profit, what would happen if he continues to do this sort of thing? In the case of expenses which are chargeable against prepaid expenses like insurance, the payment is indirect by the reduction of the prepaid expenses asset account. There's another non-cash expense. What is it? Yes. On January 10th, Johnson received an invoice from Electronic Supply Company dated January 8th for $100 of capacitors, payment net 30 days. Electronic Supply's invoice had the number 264,812 on it, but Johnson assigned it his invoice number 110. The package of capacitors came in that afternoon, so he wrote, "Received shipment in full, 210RJ" on the invoice, and filed it in a pouch with a planned payment date. What was it? Right. February 9th is 30 days after January 8th. At the end of the month, the unpaid invoices and bills were listed and totaled. What account should carry this total? Yes. You remember that on the first day of operation there was $1,000 payable for materials purchased for inventory. Johnson bought $1,000 of parts during this month. Let's assume he also paid $1,000 on accounts for purchases for previous or new purchases. This still leaves $1,000 payable for the parts in inventory. For our purpose, we will also assume that on January 31st, no salaries have been paid yet, but they have been accrued for payment on February 1st, and that Bob Johnson has not drawn any money from capital. If Johnson works full-time in his company and is not paid a specific salary, his drawings are in lieu of salary. If you were an accountant and noticed that Bob Johnson withdrew $1,000 for personal use, what would you think?
Accountants may be considered as experts who merely employ accepted accounting principles, but never apply personal value judgments to financial situations. This obviously cannot be entirely true, since nearly every entry has aspects which may be considered by the accountant. In general, it is best to withhold judgment, since it's often impossible to know the whole story at once. In this example, employees withholding taxes would be payable on February 1st and would be set up as a liability in the taxes payable account. As of January 31st, where is this potential liability? Yes. Here we have simplified the chart of accounts by combining some accounts which would probably be set up separately, such as withholding tax payable, FICA, federal and state unemployment tax, and perhaps other taxes payable, such as sales taxes. Other accounts which may be shown separately relate to sales and to purchases. What are they? Right. Another account related to accounts receivable is allowance for bad debts to allow for customers who do not pay their accounts. Why isn't there a similar account related to accounts payable? We've also ignored a number of other accounts for assets or expenses, such as office or store equipment, or the cost of their rental. We will assume this is included in miscellaneous expenses. In addition to interest expense, there may be a revenue account called interest earned, but here both have been omitted for simplicity. A typical sale may be to Ellen Green for the repair of her television set. Parts were sold for $20, and $24 was charged for repair service. Sales tax of 5% was charged on the parts only, and the bill was paid in cash. Sales slip number 127 was made out. What did it show? Right. A copy of the sales slip was placed in a drawer along with some others, and on the next day an entry was made in the General Journal which noted the date of the transaction, the cash received, and the parts, labor, and tax accounts which were charged. What entry amounts were made? Yes. Such an entry in all four parts would be made in the cash receipts journal or book if such a subsidiary journal were maintained. In a few days, the journal entry was posted to the four accounts. If the transaction was in a general journal, it would be posted separately to the cash account, but if a special subsidiary cash receipts book is kept, it would be included in the single total cash amount posted. The parts of the entry for parts and service sales may be individually posted as credit to the respective accounts, or they may be included in a single total posting of cash sales from the cash receipts book. This would be done for sales tax, too. How would you describe a cash receipts book? Yes. An account such as cash or notes payable usually has a net balance. That is, the total of debits and credits are unequal. The entire general ledger of accounts, of course, due to the double entry system, should balance out. How can Bob Johnson be sure of this? Right. In the same way that the total of ledger accounts must balance, the total of debits and credits of journal entries must balance. Johnson TV Repair keeps a general journal and special cash, sales for credit sales, and purchases journals. What would you call the process of checking them for proper balance? If Robert Johnson's business grows, he will probably be unable to finance its growth from earnings and will want to borrow some money from his bank. The banker will need to know as much as possible about Johnson's sales, earnings, and present condition. What reports provide this information? Right. To produce these reports each month, quarter, or year, Bob Johnson's wife, Betty, helps out by taking the column totals in the journal, if it is a general journal or combined cash journal, or the special subsidiary journals, and proves the footings. At this time, errors are found and corrected. Any posting to accounts which has not been done is completed. The bank balance is then proved and reconciled with the bank account statement for the month just completed. The other ledger accounts are then footed, showing the net debit or credit balance. At this time, a worksheet with a list of the accounts and their net balances is made up. The overall debit and credit totals are shown. What would Betty call this worksheet? Yes. And if the trial balance, or a list of accounts with their balances, is incorporated into a multi-column period worksheet, the adjustments for depreciation, the use of prepaid expenses such as insurance, and the revenue and expense accounts can be conveniently made, and the income statement and balance sheet figures can be generated. There are millions of organizations whose operations must be recorded and reported to their owners or members and others. Most of them, of course, are small, simple firms which do not require elaborate books of accounts. But in most of them, the procedures used require one or more journals, books of original entry, and one or more ledgers of accounts in which transactions are classified so they can be controlled, and from which data is taken to prepare periodic reports.